Hey, Chris.
Cam, how are you?
Good, mate. You've got some news.
Yeah, I do, actually. Yeah, probably more for the wider client base rather than mine. They got an update early in the week, but I had a son 6 weeks ago, little Felix.
6 weeks now. Wow.
Yeah, 6 weeks tomorrow. So, that's been... I don't know what the word I use for it.
Amazing.
Yeah, it's been pretty incredible. Just, I guess, tiring. As most new parents would understand. But, it's been good. Enjoying it.
Pleased to hear that, mate. Yeah. We missed you last time. We had Lynn on.
Yes, that's right.
But now we're going through... It's been a few things happen over the course of the last, 6 months, really. But what we're going to go through is the last 6 weeks.
Yep. A few things is a bit of an understatement. So,
So, guys, I guess we've put together the monthly market and economic update that we're keen to work our way through today.
Yep.
We might actually just start with the VIX. Now, regular viewers would understand, because we've talked about this a couple of times.
We have.
The VIX is a measure of, how much volatility there is in the markets, both up and down.
Yep.
And actually, the last time we spoke, this little part there was where the VIX was at the last time we did this update. You can see it's come off a little bit since then, but the volatility is still relatively high, sitting at a VIX of 25.
Yep. So anything above 30 is considered extreme. So, as we're hovering around that point, we're not too far away. Everything seems quite uncertain, I guess is a way to put it.
It does. And I suppose to ensure that we're expanding on that a little bit, what we've done here, we did this morning, it's just an update on where equity markets are at and what they've done over the course of the last 12 months. So the S&P 500 there, you can see it's down 11.07% in the last 12 months. S&P 500's the US equity market. All ordinaries as a measure for the Australian equity market, that's down 10.2 over that same period. But then you've got the NASDAQ, and another one we put in there is the DAX, which is down 21 and 17. So it's been quite an extraordinary time in terms of equity markets, and we've seen some reductions over that period.
Yep.
It's been worse. You can see we almost got down to a minus 30 on the NASDAQ and a minus 20 on the Aussie and the US equity market.
Yeah, it's interesting now, isn't it? You see the run up to December, or I guess what is marked as January on that. You can see the volatility difference where, if you mark that January time point off, the divergence in terms of how things have gone since then has been pretty significant. So, for those of you, it's been hard to not know what's going on unless I guess you're completely removing media and news from your life. Everyone's kind of aware of what's happening, at least on the equity market side. This is just a graphical explanation of what we've all been experiencing.
I think this also points to timeframes a little bit. So if we were to draw that line from, say, that January period where markets were generally across the board up 10, and now markets are generally across the board, say, average down 15, that peak to trough period is actually a minus 25.
Yeah, correct.
So it really is dependent upon timing in a lot of ways.
Absolutely.
Yeah.
And if you stretch that chart back a further 12 months, it would look sort of
much
better. Better in terms of you wouldn't be capturing all half the chart being downside. 2/3 of it would be up, 1/3 of it would be down, and in terms of time point to time point, you'd be broadly flat. So all of this, and I guess we'll come into the overall thesis behind all this whilst we're saying what's going on. The key takeaways are, as you all would have heard from all of us, it's time in the market that is the thing that generates the long-term outcomes for our clients.
That's right. Moving on now to the other part of the portfolio, and I suppose it's different for every client, of course, how much fixed income exposure they've got. But one of the things we wanted to illustrate is how fixed income markets have really come off over the course of the last
6 months. Really.
6 months,
And this is interesting too, because I think this is the part of the portfolio that most of the clients I've been talking to haven't. I guess you don't see this in the news.
No.
and so because this is not your typical equity part of the portfolio, so it's this has been the part that clients have probably had less understanding about when we've been catching up for reviews.
And it's been significant too. So what we're representing there is Beta Shares, that's the Australian Government Bond Fund. So it's essentially a reflection of Australian government bonds.
Yeah.
And that, for the last 12 months, is down 16%.
It's
Australian government bonds.
I'm still a bit flabbergasted at those numbers. Like it's
oversold.
they're so big. Yeah, and look, and as Cam would probably just about to point out, the bottom one you can see down there's the global index, and that's down 12 as well. So, if you're looking at a totality of a portfolio where you've got typically, so when we're talking about fixed income, that's the defensive part of the portfolio. Typically, the portfolio design is share markets go up, bond markets or fixed income markets might come off a bit, share markets go down, fixed income markets go up. So it's meant to be a ballast, one offsetting the other. Portfolio design is not meant to be that all assets rise and fall in concert, because that would defeat diversification. We're in a period now which is both are falling together by similar numbers, yeah, which looks horrific on the performance reports.
I think this is just a period of time where this is what's occurred, because one of the things we were keen to chat through is we're now looking at what we call carry, which is essentially a proxy for expected future return out of bonds.
Yep.
Now sitting around 4-5% a year, whereas back in December we were looking at carry of 2 to 3%. So the expected future return has now, in some cases, tripled that part of the portfolio, because we've seen such a reduction.
Yep.
It's just, the pain hasn't been great, and this is and we'll talk about this in a minute, but this is primarily as a result of the higher inflationary environment. Yep. So Reserve banks have put interest rates up. So that -16 for Australian government bonds, if you hold those Australian government bonds to maturity, you get all that back, don't you?
Correct, exactly right. So it's interesting. The way I explain this to clients is it's kind of a bit like a term deposit that you can buy and sell in the intervening period. So if you were to invest for typically the term deposit length on these types of assets are say 7 years. If you buy a 7-year term deposit, you get the rate of return at the time you buy it. Yeah. If you hold it to maturity, you'll get your capital back, because, look, underlying this, it's Australian government bonds. So unless the Australian government defaults on their debt, which is, well, it's possible, but it's exceptionally unlikely, you'll get your money back. You'll get your money back and the rate of return.
Yeah.
It just so happens that in the intervening time period, it's in this case they're repriced on a daily basis, which you just don't see in a term deposit. So it still has the same effective end outcome if you hold all the way through. It's just you're seeing the on paper number come down, which feels horrible.
Yeah. All right, moving on. And I suppose this is just a reflection of the 10-year US government bond yields increasing significantly. So, I mean, the top line there is US government bonds. The 10-year yield got down to about 1. Now you've expected the 10-year yield sitting at about 3%. That is. In Europe, we're looking at a much more extraordinary increase. Actually, we used to have negative bond yields in Europe of -0.5%. So what that meant was you would pay to buy.
Correct.
That's right. You would pay to buy European paper.
Yep.
Now we're looking at returns of triple that.
Yep. So, pretty incredible.
It is. Do you want to talk through this one?
Yeah.
Inflation?
So look, it's basically, obviously, you can see on the right hand side of that chart is that we're highlighting there is that if you come back to end of 2021, inflation expectations. Or actual inflation was pretty low. And then you can see, obviously, the steepness of the rise in that over the last sort of 6 months or so has really rocketed up, both in terms of headline number and the core number. So for those who aren't aware, The core is you take the top and the bottom off in terms of the statistics you've got, and you're effectively left with the core inflation number. And so, that's, I guess, more of an indication of the trend across the basket of goods in CPI. But as you can see, that has risen incredibly steeply comparatively to, the last, it goes back to 2003, so the last sort of 20 years. There aren't really too many periods that have gone that high that quickly over that time period. So we are actually in pretty extraordinary period of time. Yeah. And look, that is as a result of, I suppose, monetary and fiscal policy from financial crisis, and COVID has been an extension of that. And it's, look, there are factors which we'll probably go into here, but it's pretty incredible.
I suppose there's two factors as part of inflation, isn't there? There's supply side inflation, which is really driven by China lockdowns and essentially COVID, which continues.
Correct.
And then there's demand pull inflation, which is when wages increase more significantly, and then there's more spending that's going on in the economy. So subsequently, we see price of goods rise.
Yeah, definitely. I think, interestingly, at this point too, there's probably the Russian invasion of Ukraine is pretty important, because that has really put pressure on energy supply, which has driven prices up, and obviously energy input then flows through to everything. So petrol prices go up, and you've got to truck something from Brisbane to Melbourne. That is then put into the cost of moving that piece of good or whatever it is from there A to B, and that's just going to get passed on. So, that all feeds in as well.
So increasing interest rates, which is what we're about to talk to in a minute, which is what we've seen the Reserve Bank do and the Federal Reserve do. Yep. Increasing interest rates, how does that stop inflation?
Well, essentially, it's just trying to
reduce inflation.
Just trying to make things, I guess, well, if you think about it, more expensive. So petrol pump, for example, you were telling me this morning how
$2.60 yesterday. $2.60
for petrol. So, you're going to, versus, I guess, what you were spending, say, a few months ago, probably not, let's say December, your then natural reaction is to say, well, I'm not going to drive places because I don't want to purchase petrol at $2.60. So your consumption or demand into that portion of the economy is lower. So that will then feed. And if you think about, that's just one decision, but then there's also going to be, that then means I've got less surplus cash flow every fortnight to say, go and buy food. Now, obviously, food's another one of the core goods in that basket. Food prices are obviously going up. There's various factors for that. Energy is one of those inputs. So, food costs more at the supermarket, which means then you've got less money to spend discretionarily through the rest of the economy. So basically, it's affecting your decision making.
And so, therefore, we don't spend as much.
Correct.
And so that reduces GDP.
Correct.
But also reduces inflation.
Correct.
Yeah. Yep. It is fascinating that, so when I spent $2.60 yesterday at the petrol pump, the first thing I did do is not fill it up completely. Yep. Because I had an idea in my mind as to how much I wanted to pay for petrol yesterday.
Yeah, exactly.
The second thing I did is I hadn't had lunch. And it was about 2 o'clock, 2:30. And I'd normally just grab a sandwich from, I'm one of the people who grabs a sandwich from
the service station.
Yep. And I went, no, I'm not doing that.
Yep.
So
it's interesting.
That's that in action, isn't it?
Absolutely, because then that then affects the profitability of the service station, because that's where they make their margin, and then that then inputs into wages for the people who work there, and that has a cyclical effect throughout the economy. So this is happening across the board, and I've had conversations with 3 or 4 clients in the last week about them basically, how do I put as much surplus cash flow as I can into my home loan, because the big one here in Australia is interest rates. Is home loan rates. That gets passed through effective immediately, essentially. So I'm sure I've had 5 or 6 conversations. This is happening across the board in the country. Everyone's like, well, I'm not going to spend because I want to reduce my home loan, because it's typically a big part of surplus cash flow. So that's not in this data, those decisions yet. Yeah, correct. So, I would expect that would start to turn, which is what the Reserve Bank globally and here in Australia want to see.
I guess the other thing I wanted to say is we're talking from the perspective of a fairly negative outcome here, but we've already seen equity markets do that fall, peak to trough of that 20-25%.
Yeah, correct.
And so one of the things that we've been chatting about is what essentially happens is we see interest rates rise, people stop spending because they can't afford to keep spending. We get a recession in Australia, but then interest rates are higher, so that then allows the Reserve Banks to reduce rates again, which then allows for the economy to kickstart and get going again, right?
Yep.
And I think, I don't actually know, of course, but I think the equity markets around the world have almost priced in that recession already.
Absolutely, yeah.
Because we're down 25
Correct.
peaks of trough, right?
Yep.
So we're talking from a fairly negative perspective, but the idea here is we're trying to give people an understanding of what's happening and why it is happening.
Yeah, yeah. To your point about that, if for those who I guess have been doing the reading, or maybe you haven't, basically every central bank around the world, whether it be the ECB, the Fed, Swiss Bank, Bank of Australia, Bank of New Zealand, all the central banks have basically been communicating to the wider public to say, we have an inflation problem. We are trying to get inflation under control. Once we have inflation under control, we will ease rates. So it is as I guess you've said, a period in time thing, right? And it's a matter of, well, when is that? So how long is it going to take for... And there's always a lag. So, the lag's shorter here than globally. So, let's say 6 to 12 months or 6 to 9 months usually is the lag from when rates start going up before you start to see the information come through in the data. So, towards the end of, this year, sort of September-ish, we should start to see the effect of the interest rate rises flow through.
Yep.
So when's the end?
In the data.
In the data.
Yeah.
But then that will then obviously, and the reason why we're talking about the data is that then drives the decisions that the financial participants make in investment markets.
Yep.
So when we start to see, inflation's coming off, it's my expectation is, things will turn around because your comment before, kind of under your breath, where they got picked up on the bond side was it's oversold. I completely agree. Yeah. So, wait for the sharp bounce back.
Last week, we sent out an article that we put together with the help of a few external sources around the differences between strategic asset allocation and tactical asset allocation, or dynamic. And I guess it's worth, I don't know, I felt we might like to explain that.
I think it's a fantastic idea.
Okay. So a strategic asset allocation is really about setting long-term return targets, or what we think particular asset classes are going to do over that longer term. And this is the strategic asset allocation approach is the one that we follow. What it essentially means is there's no timing the market as compared to that tactical asset allocation where you're saying, well, actually we think Aussie equities are oversold and we're going to buy emerging markets, or we take a longer term view than that short term trying to pick the next crash.
Correct.
Yeah. So in terms of what the return numbers and what that's actually looked like over the course of the last 1, 3, 5, 10 years, the report or the article we sent out spoke to that a little bit. Again, we'll speak to it here as well. So what this is an analysis of, I suppose, the return outcomes that have been achieved. On the left-hand side is the tactical asset allocation funds, so the green is tactical, versus strategic asset allocation funds. These are super funds and managed funds in terms of those time frames. And what you can see there's two things I want to pick up on here. Firstly, on overall time periods, you're seeing a return which is higher using a strategic asset allocation than using a tactical asset allocation.
Yeah.
The median is higher.
Yep.
The second thing is the disparity between the returns is higher with tactical. So if you get it wrong, if they get it wrong,
Yeah.
they get it really wrong.
Yep. Yeah, exactly.
If they get it right, they get it really right.
Yep.
Now that comes in over time, but over time, over the 10-year period, they're getting it wrong more times than a strategic asset allocation.
Yeah, absolutely. It's I guess the more we see this, the more we read. During times like this, it's the more and more research just keeps coming out and just basically saying, and as per the article, right, you need to. It's not just one decision that you need to get right.
That's 5.
You need to get 5 decisions right. Every time.
Every time.
Yeah. So, the best asset managers in the world are I think the last time I read a report on this might have been a couple of years ago, but the best asset managers in the world are getting it right 55% of the time.
Yep.
It's just the size of the trades that they're getting it right or wrong on will dictate, whether they outperform or underperform.
Yep.
But when you need to make 5 decisions right every time and you're only getting that right 55% of the time, and I say this to clients all the time, we play the balance of probability. I would rather be right 95% of the time than be right 5% of the time, because that's going to greatly affect your outcomes as a client.
Yeah, spot on. And then I guess this is the other thing that you need to get right. So this is an analysis of the returns of US stock markets from 1928 to 2021. Now, if you're invested for the entire period, so you invested on day one and then you got out today, your return over that period has been 6.2% per annum. If you miss the 30 best trading days, then your return is only reduced to 5%. If you miss the 20 best trading days, it's 4%. Oh, I'm reading that incorrectly.
Yeah, so you miss the best 10, it's 5%. Missed the best 24, missed the best 33.
3. So half the return.
Yep.
So you've got to get that, if you're jumping out of the market, one, you've got to be able to buy the market back in, and then you've got to do it before the best trading day.
And the best trading days are usually immediately following the worst.
Yeah.
So, you get a terrible day, you sell, not always, but usually there's a bounce. So,
that's right.
You're going to miss those days.
So patient capital wins the day.
Correct.
And we've been in a period of time where markets have been not what we want them to be. I think it's fair to say. But if we pull that line, extrapolate that time period out, that's what makes the difference.
I think it's been a particularly hard period too, right? Because this has been happening since February of 2020. Mm-hmm. So we would typically go through maybe one of these periods every
10 years.
Yeah. Or have some sort of market retreat every sort of 3 to 5 years. And we've effectively had 2 or 3 in the space of 24 months.
Yep.
So it's been an incredibly tumultuous period, which is really hard for people. I completely understand that. But I think, we need to put it in some context that, our view is longer term. And, our advice is longer term. So it's about tying together your investment outcomes with your planning outcomes, and they're both longer term. Yes, we need to be aware of what's going on in the here and the now, but trying to get out of the trenches and taking that sort of 10,000 foot view, that's where the value is.
Yeah. Well, Chris, I think that's been a wonderful summation of where things are at the moment. This will be our disclaimer. It's all general advice.
Yep.
Not
yeah,
personal
absolutely.
advice.
Yeah. Well, can't say there's been any personal advice in there, but no. I just think it's important for everyone to really understand, I guess, what's happening at the moment, but put it. It's like to say put it in context. It feels like you're doing it's a bit tough given the current climate, but typically what happens is we look back at this period 12 or 18 months time, everyone goes, "Poor, how bad was that?" But aren't we glad we're past it? So I'm still fairly positive that will be the case. It's just a matter of
being patient.
Being patient, and steady as she goes.
All right, thanks very much, everyone. I think we're done. Thank you. Thanks, Chris.
Nice.
Till next month.
Talk to you all soon.
Hopefully you get some sleep in the next month, mate.
I hope so.
Good luck. See you, everyone.
Bye.